US stock plunge, crypto crash, and a liquidity exodus. Is the system sending a red alert? The market has sharply shifted into risk-off mode since the Fed announced it would begin tapering its mortgage-backed securities, MBS, holdings. A liquidity exodus is now underway. Last Thursday, we predicted that the Fed's tapering of MBS would initiate a reverse replay of the 2008 financial crisis, sacrificing the US stock market to maintain liquidity stability in the Treasury market. In less than a week, this forecast is materializing. November 4th, Black Tuesday rattles markets. The S&P 500 plunged 2.22%. The Nasdaq dropped 2.04%. Bitcoin fell below the $100,000 mark. Note, this figure appears to be an error in the original text. Current price is significantly lower. By the early hours of the 5th, other major cryptocurrencies had tumbled over 10%. November 5th, Asia-Pacific markets follow suit. Japan's Nikkei 225 index fell up to 5%. China's Shenzhen Component Index opened down 1.6%. South Korea's Kospi plummeted 4%, with index futures triggering a trading halt. The U.S. Volatility Index, VIX, spiked 10%. Capital has entered a flight to safety pattern. More alarmingly, the overnight funding market is sounding a liquidity alarm. On October 30th, the Fed cut interest rates, lowering the benchmark rate ceiling to 4%. However, the Secured Overnight Financing Rate, SOFR, defied this move. On the 31st, it broke sharply above the upper limit of the rate corridor, surging 22 basis points to 4.22%, its largest single-day jump in years. Simultaneously, the spread between SOFR and the center of the interest rate corridor widened to 32 basis points. This level is second only to the historic high seen during the COVID-19 crisis in March 2020. Right now, funding conditions are far tighter than normal, as if the Fed's rate cut never happened. The root cause. Two words explain it: flight and safety. As we pointed out on October 23rd, the U.S. financial system is experiencing a dangerous idling effect, with liquidity steadily draining from the banking system. The Fed's reverse repo, RRP, facility, a critical liquidity buffer, has collapsed from $500 billion at the start of the year to nearly zero at $6.5 billion in October. The exhaustion of the RRP implies the Fed's ability to control the market is faltering. The system now highly depends on trust and credit between financial institutions. Under normal conditions, if SOFR rises above the center of the rate corridor, institutions would inject funds into the lending market to arbitrage the difference, thereby pushing SOFR back down. Today, however, persistently high SOFR indicates that financial institutions have entered pure risk-off mode. They are willingly foregoing arbitrage profits to hoard cash and ensure their own safety. This has triggered a vicious cycle. Rising risk aversion makes funds harder to borrow, which pushes SOFR even higher, which in turn intensifies the risk-off mood. In other words, banks and other institutions are predicting extremely high market risk and are unwilling to lend freely. This defensive behavior is, paradoxically, amplifying systemic risk. The Fed's dilemma, a long-term cure that worsens short-term pain. To ease the liquidity strain, the Fed cut rates on the 30th and stated it will stop quantitative tightening, QT, in December. It also plans to swap MBS for Treasury bonds. The essence of this policy is to sacrifice the short-term, stocks, for the long-term, bonds, accepting pressure on U.S. equities in exchange for stability in the funding market and the long-term safety of U.S. debt. However, financial markets are now nearing a breaking point, with various risks feeding off each other. This sacrifice the short-term strategy may actually intensify short-term risk-off behavior. The funding market is stretched to its limit, and with over 20 trading days left until QT ends in December, the market isn't willing to wait. It has already begun to panic. Compounding this, the U.S. stock market's massive gains in recent years mean the negative impact of MBS tapering could be magnified. A significant pullback in stocks would further transmit risk directly into the funding markets. Thus, risk-off behavior in the funding market and the stock market are now resonating, creating a self-reinforcing, accelerating vicious cycle. This explains why the stock market is crashing and liquidity is getting tighter. The Fed's long-term medicine is ineffective, while its short-term side effects are pushing the market toward the abyss. Adding insult to injury, the Big Short investor returns. In a deeply ironic twist, just as the Fed began its reverse 2008 MBS tapering operation, Michael Burry, the famed fund manager who profited from betting against the 2008 housing bubble, publicly announced he is shorting the U.S. stock market and the AI sector. He has put his money where his mouth is. His fund has allocated 80% of its portfolio to buying put options, specifically targeting Nvidia and Palantir. The notional value of these bearish bets exceeds $1 billion. This news has undoubtedly poured fuel on the fire of market panic. In conclusion, reiterating our core thesis, we reaffirm the core view we have held since inception. The United States is standing at a crossroads, facing a triple crisis involving the dollar, U.S. stocks, and U.S. bonds. Based on the current situation, the first crack will likely appear in the U.S. stock market. Whether this escalates into a simultaneous crash across stocks, bonds, and the currency will ultimately depend on the Fed's next move. We will continue to monitor these developments closely. Stay tuned.